Hey everyone, welcome to my video on excise taxes. An excise tax is what we call it when the government taxes a good. We do this with tobacco and liquor and various goods where we just say this good's going to get taxed when you buy it or sell it. Anyway, I want to show you what these taxes look like in a competitive market. So I got three supply and demand graphs here. And in the left, we're going to show what happens when there's a tax on demand. On the right, in the middle, we're going to show what happens when there's a tax on supply. And on the right, I'll show you a general trick because it doesn't actually matter if you tax demanders or suppliers in a competitive market. Mind blown, guys. It doesn't actually matter. So, if you put a tax on demand, what you're doing is you are going to be, as a government, taking money out of the consumer's pocket. What does that look like on the graph? We're actually going to shift the demand curve down a notch to some new curve, which I will call deep demand curve with a tax. Or you could also say, if you don't want to call it that, you could say it's the demand curve minus the tax is really what's going on. We're subtracting the tax from usually measures willingness to pay. And now we're taking out of that willingness to pay. So what does this do in our market? Well, the original equilibrium quantity was here. I'll call it Q star as always. But with the tax, the new quantity is less. With the tax, the new quantity that consumers are going to want to buy is QT. So we can still focus on a supply and demand type analysis, but we're going to pay attention to this taxed demand curve. And so what's going to happen? Well, there's a few familiar features if you've seen some of my other market interventions. This is not an efficient outcome. Mutually beneficial transactions don't occur because between QT and Q star were transactions where consumers were willing to pay more than what sellers were willing to receive. And because of this tax, those transactions are pushed out of the market. So let's talk about what this does to consumers and producers in the market. In all of these videos so far, I've been showing like consumer and producer surplus after the fact. Let's take a look. Consumers are paying this higher amount. Producers are receiving this lower amount. So I'm going to put a label on here. I'm going to say this is the demand price, PD, and this lower one is the supply price. Because in reality, the people are not paying and receiving the same price. The price that consumers are paying is equal to the price sellers are receiving plus the tax. Or a different way of writing that is that the price sellers are receiving is equal to the price consumers are paying minus the tax, which means our consumer and producer surplus are going to look kind of weird here. Everything below the supply price and above the supply curve is producer surplus. Now, what about that space in between them? This yellow rectangle. Well, that yellow rectangle is not lost surplus. It's just been taken away from consumers and producers. That, you could call it government surplus. There's a more common name for it, which is tax revenue. The government will collect that money, which would have been someone's surplus, but has now been taken away as the tax. And then, of course, the last little segment is our trusty friend, the deadweight loss. Now, let's look what happens if there's a tax on supply. A tax on the supply has the effect of raising the costs for a business and then can be modeled by decreasing the supply curve or shifting it up to higher prices at every quantity. And everything else that we said about the demand curve is still going to apply. The quantity with the tax is less than the quantity in equilibrium. The demanders pay a higher price than sellers receive. And that means that there is a gap between consumer surplus and producer surplus, and that gap is filled in by tax revenue, which is collected by the government, and all of this leaves the inefficiency of a deadweight loss. All right, and the general tax wedge. So this is my cheating way of remembering this because honestly, in the end, in a competitive market, it literally does not matter if you tax suppliers or demanders. And all you'd have to do is know that whether you tax demanders or suppliers, it creates a wedge between the prices. Now, this wedge could be through taxing suppliers and looking like that, or the wedge could be through taxing the demanders and making it look like this. It doesn't matter which way you draw it. That wedge is what the tax does to the market. It splits the price that demanders pay and sellers receive. And so if you need to remember it by drawing all of these extra lines, go for it, because it totally works. But I also want you to remember that it literally doesn't matter, because the effect will still be the same. The tax creates a wedge between demand and supply. That wedge gives us some consumer surplus less than an equilibrium, some producer surplus less than an equilibrium, some tax revenue, obviously more than an equilibrium when there was no tax, but it also gives us, our friend, the deadweight loss, because the quantity with the tax will still be less than our quantity in equilibrium. So a quick recap on what we learned here. If you want to put a tax on the demand curve, decrease the demand curve, creating that DT curve. If you want to put a tax on the supply curve, decrease the supply curve. In the end, it doesn't actually matter which one you do. The tax wedge still happens either way, and nothing is actually different. If you put a tax in the market, there's going to be a deadweight loss because the tax will reduce the quantity sold and prevent some mutually beneficial transactions. The government will capture some of the surplus as tax revenue. We haven't seen that before. Some of the consumer and producer surplus will be captured by the government because it's all measured in dollars. And the less elastic side is one who pays more of the tax or has the higher share of the burden. And that was shown by the steepness of the curves. The flatter curves pay more of the tax because they're more elastic. All right, that's it in a nutshell, guys. I hope it was helpful to you. If not, too bad. Thanks for watching, and happy econing.